Many people imagine investing as a long wait. You buy something. You wait many years. Maybe one day you sell at a higher price. But there is another quiet path inside investing that pays you along the way. It is called dividend investing. Instead of waiting only for price changes, you also receive small regular payments from the companies you own. Understanding how it works opens up a different way to think about wealth. At its core, a dividend is a payment that some companies make to their shareholders out of their profits. When you own a share of such a company, you receive a small payment per share at regular intervals. These payments may be paid every quarter, every half year, or once a year. The company keeps part of its profits to grow. The rest is shared with its owners. This matters because dividends create a quieter form of return. Even when share prices move up and down, dividends can keep arriving steadily, depending on the company. Some investors love this pattern because it feels like regular fruit from a tree they planted. Others appreciate that dividends slowly reinvest and compound over time, building bigger and bigger positions without requiring extra effort or new money. To understand how it really works, picture three numbers. The dividend per share is how much money each share pays. The share price is what you paid for that share. The dividend yield is the dividend divided by the price, expressed as a percentage. Together, these three numbers help you understand what your ownership is actually returning in cash each year, separately from any price changes. Let us look at a simple example. Imagine you own 100 shares of a company. The company pays a dividend of $1 per share each year. That means you receive $100 from your ownership annually, regardless of how the share price moves day to day. If the company increases its dividend over time, your annual income from those same 100 shares grows quietly, without you doing anything new. A common mistake is chasing only the highest possible dividend yield. A very high yield can look attractive on paper, but it sometimes signals trouble. Maybe the price has dropped because investors fear something. Maybe the dividend is too high to be sustainable. A high yield is not automatically a good sign. A modest, growing, sustainable dividend from a healthy business is often more valuable than a flashy yield that may not last. There is also a hidden risk in dividend investing. Companies can reduce or even stop their dividends, especially during difficult periods. Just because a company paid a dividend last year does not mean it will continue forever. Dividends are not guaranteed. A solid dividend strategy depends on holding many strong companies, not just one or two, so that if one cuts its payments, the rest still keep arriving steadily. A useful way to picture dividend investing is as planting fruit-bearing trees. The trees themselves are companies. The fruits are dividends. Some trees grow taller over the years and produce slightly more fruit each season. Some struggle in bad weather and produce less for a while. With many trees of different types in your orchard, the overall harvest can stay reliable, even when individual trees have ups and downs. A second key idea is the difference between dividends paid out and dividends reinvested. You can take dividends as cash and use them to live on. Or you can automatically reinvest them, buying more shares of the same company or fund. Reinvested dividends turn the basket bigger and bigger over time. The next round of dividends is then paid on a larger position. Compounding quietly accelerates the entire process. A practical example helps. Imagine two investors who own the same set of dividend-paying companies. One spends all dividends as soon as they arrive. The other reinvests every dollar back into more shares. After 20 years, the second investor often owns far more shares and receives far larger dividends. Their basket has quietly multiplied through nothing more than disciplined reinvestment over a long period of time. Beginners often misunderstand the role of dividends in total return. A stock's total return includes both price changes and dividends combined. A company with a modest price gain plus a steady dividend can quietly outperform a more exciting non-dividend stock over many years. Looking only at the share price ignores half of the picture. The truthful measure of how an investment treated you is always price growth plus dividends. There is also a psychology angle. Dividends can make investing feel emotionally easier. When prices fall, the regular payments keep arriving. That cash flow can comfort nervous investors and reduce the temptation to sell during scary periods. Many long-term investors enjoy dividends as much for the psychological reassurance as for the actual money. Calm investors usually hold longer and benefit more from compounding over many decades. A simple practical rule helps you approach dividends wisely. Focus on companies or funds with a long history of paying steady or growing dividends. Look for sustainable payout patterns, not extreme yields. Diversify across many businesses and sectors. Reinvest while you do not need the income. Switch to taking cash payments only when the income becomes a meaningful part of your financial plan later in life. There are things to avoid. Do not buy a stock purely because of its dividend without understanding the underlying business. Do not concentrate everything in a single high-yield sector. Do not assume tax treatment is the same everywhere, since rules vary by country. Do not abandon dividend strategies during normal price dips. And do not believe that any dividend is guaranteed, no matter how long a company has been paying it. A better habit is to combine dividend investing with broad index investing. Even if you love dividends, holding a wide variety of companies, including some that do not pay dividends, can produce strong overall returns. The two approaches do not have to be enemies. They can complement each other. Diversification across both styles often produces calmer results than chasing one approach as if it were the only correct path. Over the long term, dividend investing can quietly transform a portfolio. The combination of regular payments, gradual dividend increases, and patient reinvestment creates a slowly rising stream of income. Eventually, that income can support real-life needs, like retirement spending or supplemental cash flow. The journey is slow, but the result is a calm financial structure that pays you while you sleep, year after year. So here is the short version. Dividends are payments some companies make to their shareholders from profits. The dividend yield shows how much income you earn relative to the share price. Reinvested dividends compound powerfully over time. High yields can hide risk. Sustainable dividends from many diversified businesses are usually safer than chasing one big payout. Total return is price changes plus dividends combined. If you want a calmer, steadier feel to your investing, dividends can play a meaningful role. Build a diversified mix of healthy dividend-paying businesses, possibly through a low-cost fund. Reinvest while you can. Avoid chasing extreme yields. Pair the approach with broader market exposure. Then let time and consistency do the heavy lifting. Over many years, a quiet orchard of paid-up ownership can become one of the most peaceful parts of your financial life.